Hello, this is the 30th episode of What Would Peter Lynch Do? Our continuous exploration of the wisdom of legendary investor Peter Lynch. And today, we're digging into a really great question from one of you. You mentioned being very interested in stablecoins, seeing all the talk, especially Circle's recent listing news, and you asked, I don't understand cryptocurrencies at all. Please explain them in detail. Why is the US government, which was negative, suddenly supporting them? Fantastic questions. They really cut to the core of a lot of the shifts happening in finance. So our mission for this deep dive is pretty clear. Break down Bitcoin versus stablecoins, try to figure out the government's angle, which is, well, complicated. We'll also look at those key stocks you mentioned, like Circle, Coinbase, Robinhood. And crucially, we want to tie it all back to Peter Lynch's timeless investment ideas, especially helpful if you're maybe newer to stock investing. We want to give you some clear takeaways.
Yeah, that's the plan exactly. Cut through the noise, the jargon. Explain not just what these things are, but, why they matter, why they're causing such a stir, and what it all could mean for how you think about finance and maybe potential investments.
Perfect. Okay, let's start right at the beginning. The difference between Bitcoin and stablecoins. They're both digital assets, sure, but really they're almost opposites in purpose, aren't they?
Absolutely. Polar opposites in some ways. Think of Bitcoin BTC as the pioneer, the original. So it's called digital gold. First decentralized digital currency built on blockchain, no central bank needed. And a key part of its design is scarcity. Only 21 million Bitcoin will ever exist. That scarcity, like physical gold, is core to its value proposition.
Okay, digital gold because it's limited. But everyone knows about the price swings, right? That volatility.
Oh yeah, legendary volatility. That's its main characteristic, really. Demand goes up, price can soar, people sell, it can crash just as fast. So it's seen mostly as an investment, an asset you hold, hoping it appreciates. Not really for, buying coffee. It does allow fast, cheap, global transfers between people, no banks involved. That's a plus. But yeah, the wild price swings make it tough to rely on for stable value or daily use. And that's where stablecoins, well, that's their whole reason for being.
Right, the name gives it away. Stable, the exact opposite of Bitcoin's volatility.
Precisely. Stablecoins are built to hold a steady value.
Yeah.
Usually they're pegged to a real-world asset, most commonly the US dollar. Take USDC, USD coin as a prime example. Circle, the company that issues it, makes sure that for every USDC out there, they hold one actual US dollar in a bank account or similar safe assets. So one USDC is designed to always be worth $1. It's basically a digital dollar.
Bitcoin digital gold.USDC. Digital dollar. Got it. That's a really clear way to put it. But why use a digital dollar instead of, well, a regular dollar? What's the main use case?
Well, a big one is in crypto trading itself. If you're trading Bitcoin or other volatile coins, and the market looks shaky, you can quickly convert your holdings into USDC to kind of sit out the storm. It's like a safe parking spot for your value. And beyond trading, they're proving to be way faster and cheaper for sending dollars overseas compared to traditional banking.
Okay, let's nail this down for everyone listening. Can you just bullet point those key differences one more time?
Sure thing. Nickname. Bitcoin is digital gold. Stable coins are like digital dollars. Value. Bitcoin, super volatile. Stable coins. Stable, generally one coin equals $1. Main purpose. Bitcoin is mostly for investment holding value. Stablecoins are for stability, trading, sending money. Who issues them? Bitcoin. Decentralized network, no single boss. Stablecoins. Usually a central company, like Circle, that holds the backing assets.
Perfect. Crystal clear. Now let's get to that other big question from our listener. Why is the U.S. government, which was negative, suddenly supporting them? It really does feel like a big shift from the outside looking in.
Yeah, I understand why it looks that way. But it's less a sudden U-turn and more like a careful balancing act. A tightrope walk is a good way to think about it. The government isn't giving crypto a blank check, It's this dual approach, support on one hand, regulation on the other.
Okay, so not full support. What's driving the support side then? Why the interest?
Well, there's the potential for innovation and economic growth, right? Blockchain, crypto. They see it as a possible new engine for finance. Could create jobs, keep the country competitive globally. Plus, the transparency aspect of blockchain is interesting. Could lead to a more efficient financial system, maybe. And, believe it or not, some countries are even looking at Bitcoin as a potential strategic reserve asset, like holding digital gold alongside physical gold.
Right, the innovation angle. But what about the other side of that tightrope, the regulation part? What are the big worries?
The worries are definitely real. Investor protection is huge. These assets are volatile. Ordinary people can lose a lot of money quickly if they jump in without understanding. Governments need to protect consumers. Then there's the illicit finance concern. The anonymity or pseudonymity can be misused for money laundering, funding crime. That's a major headache for law enforcement. And maybe the biggest underlying fear for some is that if crypto gets too big, could it threaten the existing financial system, the one managed by central banks?
So it's this constant push and pull, trying to encourage the good stuff while clamping down on the bad.
Exactly. Most governments are trying to thread that needle, create rules to protect people and prevent crime, but not so harsh that they kill off the technology and its potential benefits. It's more pragmatic than, say, purely ideological.
That government balancing act makes perfect sense, and it really sets the scene for where we see the impact hitting the real world, the stock market. So let's pivot to those companies you asked about. Circle, Coinbase, Robinhood.
Right, because as this whole crypto space keeps changing so fast, one way people are getting exposure is by investing in the companies around it, the ones listed on stock exchanges. It's become really popular.
Let's start with Circle, issuer of USDC, which we just talked about, and they just had news about listing on the NYSE.
That's the plan, yeah. Listing anticipated for June 2025. Circle's interesting because its business model is seen as quite stable, especially compared to the rest of the crypto world. Like we said, they back USDC with real dollars, but they don't just let that cash sit there. They invest it in very safe, liquid assets, mainly U.S. Treasury bonds,
Right.
and they earn the interest from those bonds. So the more USDC people use, the bigger that pot of reserves gets, and the more interest income Circle potentially earns. It's almost seen as a kind of blue chip play within crypto because of that stability. The listing news definitely got attention.
That's fascinating. Using the stability of the stablecoin itself to generate revenue, what's the investment case boiled down?
Well, the core logic is that stable revenue model, first off. Plus, they benefit hugely as regulations become clearer and big institutions get more comfortable using stablecoins. Think transparency builds trust. They're positioning themselves right in the middle of future payment systems, cross-border stuff, company-to-company payments. They've got partnerships with giants like Visa, BlackRock. But there are risks. Their profits depend on interest rates staying decent. If rates fall, they earn less. Also, after an IPO, valuations can sometimes be high, and competition is heating up. PayPal's got its own stablecoin now, PYUSD. Banks are exploring it too.
Okay, Circle is the stablecoin issuer with an interest-based model. What about Coinbase? Probably the best-known crypto exchange, right?
Definitely one of the biggest globally, yeah. Coinbase is the platform where millions buy, sell, hold Bitcoin, Ethereum, USDC, lots of others. Now, its stock is very tied to the ups and downs of the crypto market itself. When Bitcoin's booming and lots of trading is happening, Coinbase makes more money from transaction fees, and the stock usually does well. But when things cool down, a crypto winter, they call it, trading slows, revenue drops, and the stock usually takes a hit.
So very much riding the crypto wave. How do they try to smooth that out? You mentioned diversification.
Good question. That market dependence is their biggest risk, no doubt. But their investment case focuses on a few things. One, they're a dominant player, especially in the U.S., huge brand recognition. Two, they're arguably the main gateway for big institutions, pension funds, hedge funds entering crypto. They provide trading, custody, that brings in more stable business-to-business revenue. And three, yeah, diversification. They're pushing into things like staking, where users earn rewards on their crypto and their Coinbase One subscription for lower fees and other perks, trying to build more predictable income streams. Still, that reliance on market cycles and growing competition pushing fees down are real risks.
And the third one our listener asked about, Robinhood. Known for commission-free trading, popular with younger folks.
Right. Robinhood offers stocks, options, and crypto. Crypto trading is a decent chunk of their revenue, so they're also affected by market sentiment there. What's getting attention lately is how they're trying to blend traditional finance and crypto. Like they launched 24-hour trading of tokenized U.S. stocks in Europe using blockchain, kind of blurring the lines.
So they're not a pure crypto play, but crypto is definitely important for them.
Exactly. The investment thinking is diversified platform, strong appeal to younger demographics, which means growth potential, and they keep adding new products. Risks. There's still some controversy around their main revenue model called payment for order flow, or PFOF. And because they aren't a pure crypto company, they might not get the same kind of explosive growth if crypto really takes off compared to, say, Coinbase.
Makes sense. Okay, one more quick mention before we dive deeper. MicroStrategy. You hear it called a Bitcoin proxy.
Yeah, MicroStrategy is technically a software company, but its main claim to fame now is that it holds tons of Bitcoin on its balance sheet, more than any other public company. So its stock price basically just tracks the price of Bitcoin, but often with more leverage. They've actually borrowed money, issued debt, specifically to buy more Bitcoin. This means if Bitcoin goes up, MicroStrategy stock can go up even faster. But flip side, if Bitcoin drops, MicroStrategy can drop even harder. It's super volatile, much riskier than just holding Bitcoin itself.
Got it. Extreme leverage play on Bitcoin. Okay, that maps out the key companies nicely. Now, let's circle back to those really sharp questions from our listener. The why questions you asked. If I have to make an overseas remittance, do I have to buy cryptocurrency? And for Circle, if it's one-to-one dollar value, why would I buy and hold it? Also for remittance, why all the buying and selling and trading? Why not just buy, pay, and hold? These really hit the nail on the head, don't they? They get to the fundamental reasons these things exist.
They absolutely do. Brilliant questions. They force us to explain the actual value proposition. Let's take them one by one. First, overseas remittances. Do you have to use crypto? No, of course not. But using stablecoins is rapidly becoming a much better option. Faster, cheaper, easier.
Better than a standard bank wire transfer? How much better?
Think about sending money internationally through your bank. It uses the SWIFT network, usually. Speed. Takes days, typically. Cost. Can be really high with bank fees, correspondent bank fees, not great exchange rates. Access. Only during bank hours. Transparency. Hard to track. Sending, say, $1,000 from the UK to the US might cost you $30, $50 in fees and take 3 days. Now, using stablecoins like USDC. Speed. Minutes. Cost. A tiny network fee, often pennies. Access. 24/7. Transparency. It's all verifiable on the blockchain. You convert your pounds to USDC, send it instantly to your friend's USDC wallet. Takes minutes. Costs next to nothing.
Wow, okay, that's a night and day difference. Like sending an email versus posting a letter.
Exactly the analogy I often use. It just removes all those slow, expensive middle steps.
All right, second question. Why buy and hold something like USDC if it's always worth $1? Especially if I already have dollars in the bank.
Right. Seems counterintuitive if you're already in dollar economy.
Yeah.
But there are key reasons. One, it's often the entry ticket or the base currency for the rest of the crypto world. Buying Bitcoin or Ethereum directly with dollars can sometimes be clunky or have higher fees depending on the exchange. So the common path is convert dollars to USDC, then use USDC to buy Bitcoin or whatever else. USDC acts like the dollar within the crypto ecosystem. It's the bridge.
Okay, so it's the main on-ramp currency for crypto trading. What else?
Your two, think of it as a digital savings account that can potentially offer much higher interest. Your bank might give you, 1%, maybe 2% interest on your savings. You take that same USDC and deposit it into what's called DeFi, decentralized finance protocols. And these platforms might offer annual interest rates of 5%, 10%, sometimes even more. It's like a parallel blockchain-based financial system offering higher yields, though often with higher risks too.
Higher yields. Okay. But higher risk, you mentioned. What kind of risks are we talking about with DeFi?
Yeah, that's crucial. The yields don't come free. Risks include things like bugs in the underlying smart contracts that run these DeFi apps. Someone could exploit a flaw and steal funds. There's platform risk. The protocol itself might fail. And market risk, the value of other assets involved, could fluctuate wildly. So getting that 10% yield requires understanding and accepting significantly more risk than putting money in an FDIC-insured bank account. Due diligence is key. And a third reason to hold stablecoins. They let you use the value of dollars instantly, anywhere, without needing a bank. Think about someone in Argentina, where the peso is incredibly unstable. Converting their savings into USDC gives them a stable digital dollar asset they can control directly, send globally 24/7. It's like having a borderless dollar account. Huge value there.
That stability aspect is incredibly powerful for people in volatile economies. Okay, last part of that question cluster. Why all the trading of stablecoins if they don't change price? Why buy, sell, trade?
Right. You're not trading USDC hoping it goes from $1 to 1.5 cents. That's not the point. The massive trading volume comes because stablecoins are the primary means of transaction. They're the payment currency and the safe asset within crypto.
The means, not the end goal. How does that create so much volume?
Well, first, they're the bridge, like we said. Every time someone wants Bitcoin, they often sell USDC to buy it. That's a BTC-USDC trade. When they want to sell Ethereum, they often sell it for USDC, an ETHUSDC trade. Most trading pairs for smaller cryptocurrencies are against stablecoins. All those trades, back and forth, add up to enormous volume. Just like the US dollar is involved in most global trade, stablecoins are involved in most crypto trades. Second, that safe haven. When the market looks like it's about to tank, traders don't want to convert back to slow, expensive traditional dollars. They quickly sell their Bitcoin or whatever for USDC, park their money there safely. Then, when they think the bottom is in, they use that USDC to buy back into Bitcoin. That constant moving in and out of stablecoins during volatile periods generates a huge amount of trading activity.
Got it. So Bitcoin is the asset you speculate on or hold for value. Stablecoins are the digital dollars you use to trade, to move value, to seek safety. They're the lubricant, maybe even the blood, of the crypto economy.
That's a perfect way to summarize it. Bitcoin is the store of value potential. Stablecoins are the medium of exchange and stable unit of account within that digital realm.
Okay, this naturally leads to another critical question. If stablecoins and crypto are so efficient, does that mean traditional players, Visa, MasterCard, PayPal, the Fintechs, are they just going to disappear? I mean, my money's already digital numbers in my bank app. What's really different? Do we need this?
That's the billion-dollar question, isn't it? And the answer overwhelmingly seems to be no, they're not disappearing. They're adapting. And the difference isn't just the numbers on your screen. It's the underlying plumbing, how that money actually moves. That's what stablecoins aim to innovate.
Adapting how? Are they fighting it or joining in?
Mostly joining in, or at least trying to leverage it. Look at Visa and MasterCard. They're actively running pilots using stablecoins on blockchains for things like cross-border payments. They see it as a way to potentially replace their old complex settlement systems with something faster and cheaper. They're essentially looking to upgrade their own payment rails. PayPal went a step further and launched its own stablecoin, PYUSD. You can swap dollars for PYUSD right in the app, send it, pay with it. They clearly see this as the future. Even Block, formerly Square, they're deep into Bitcoin services with Cash App, building new financial tools. So they're positioning themselves as bridges, using their existing user bases or even becoming direct players.
Okay, so they're getting involved. But back to the plumbing. You said that's the key difference. My current digital payments feel instant when I tap my card. What's wrong with the current plumbing?
This is crucial. It's the difference between payment and settlement. When you tap your card, yes, the payment authorization is instant. You get the okay. But the actual money moving from your bank through various networks to the merchant's bank, that settlement takes 2-3 days. What happens instantly is just a message, basically an IOU. This person is good for the money. We'll sort it out later. It's a complex, closed system involving lots of intermediaries, and that's where costs like the 2-3% merchant fee come from. It's like sending international mail. It works, but it's slow, costly, and you don't see all the steps inside.
Okay. And stablecoins change that because?
With stablecoins, when you send USDC from your wallet to someone else's, the payment and the settlement happen almost simultaneously on the blockchain. The actual digital asset, the value, moves directly. There's no IOU, no 2-3 day delay for the final settlement. It's an open network, peer-to-peer, with very low fees. Like sending an email, the message and its delivery are practically instantaneous, cheap, and transparent.
Right. So it's not about the digital display. It's about ripping out the old, slow, expensive pipes underneath and replacing them with faster, cheaper, more open ones.
You nailed it. That's the core innovation. Benefits. Merchants don't pay high fees or wait days for their money. Sending money overseas becomes instant and nearly free. And this open financial plumbing allows for all sorts of new DeFi services to be built on top.
Okay, but if those transaction fees, which were the bread and butter for card companies, start shrinking, how do Visa, PayPal, and others make money in this new world? Where does the revenue come from?
Their business models will have to evolve, absolutely. Just like other industries disrupted by tech, think music, media, new revenue streams are definitely emerging.
Like what? What are the new models?
We can group them into a few areas. 1. Revenue from being the financial highway infrastructure providers. Think B2B services. This includes on-ramp, off-ramp services, helping people easily convert cash to crypto and back, charging a small fee. Also providing APIs or blockchain as a service, letting other businesses use their tech infrastructure. Operating payment networks for institutions. 2. Revenue from trust and security solutions. Crypto still feels risky to many, so trusted brands can offer services like secure custody for digital assets, identity verification, KYC/AML, to prevent fraud, maybe even payment insurance. And 3. Revenue from integrated financial platform services, more B2C. Imagine super wallets apps like PayPal or Cash App where you manage everything. Cash, stocks, crypto, they can earn from facilitating trades, offering crypto-backed loans, maybe acting as brokers for those high-yield DeFi products we talked about.
Okay, so they shift from being toll collectors on the old road to offering a whole suite of services, infrastructure, security, integrated apps on the new highway. That makes sense. Now, the moment we've been building towards, how does the wisdom of Peter Lynch help us navigate all this? How can someone listening get practical hints for stock investing in this very dynamic crypto age?
Right. This is where Peter Lynch's ideas are just so valuable, even though he wasn't investing in crypto back in his day. His core philosophy applies perfectly. I've actually sketched out a kind of map of cryptocurrency-related stocks based on his thinking.
Ooh, a map. Let's see it.
Okay, think of it in tiers based on how directly they're tied to crypto. Tier 1, the direct players. Companies like Coinbase, Circle, Robinhood, maybe even MicroStrategy. Their fate is very closely linked to the crypto market itself. Highest potential rewards, probably highest risk and volatility too. Investing here is a direct bet on crypto adoption growing massively. Tier 2, the center of transformation. These are the big established financial players. Visa, MasterCard, PayPal, Block, even major banks like JP Morgan that are getting involved. Their old businesses might be challenged, but they also have huge resources to adapt and potentially dominate the new landscape. Investing here is betting on these giants successfully integrating crypto. Tier 3, indirect beneficiaries, or what I call the enablers and guardians. Think cybersecurity firms like Palo Alto Networks or CrowdStrike. As billions flow into digital assets, security becomes paramount. These companies benefit as the whole ecosystem grows, but they're less tied to daily price swings. Investing here is betting on the essential security infrastructure growing alongside crypto. Tier 4, the gold rush's genes.
Lynch famously said that during the gold rush, the people who made the real money sold the picks, shovels, and jeans like Levi Strauss. In the crypto world, that could be the semiconductor companies, NVIDIA, AMD. They make the powerful chips, GPUs needed for crypto mining and processing blockchain data. Investing here is betting on the essential hardware needed, regardless of which specific cryptocurrency wins out.
That tiered map is incredibly helpful for framing the different kinds of bets you can make. Now, overlay Peter Lynch's core principles onto that map. What would he tell us?
Okay, principle number 1, invest in what you know. This was huge for Lynch. He believed your personal experience gives you an edge. So, for Tier 1 stocks like Coinbase or Circle, have you actually used the Coinbase app? Does it seem easy? Fair. Can you explain Circle's business model earning interest on reserves simply to someone else? If you can't understand the basic business, Lynch would likely say, stay away. Focus on business clarity, not just fancy tech. For Tier 2, like Visa or PayPal, are you a customer? Have you tried their crypto features? Do they seem useful, convenient? Pay attention to your own experiences with these companies as they adapt.
Right, use your Main Street knowledge. What about his idea of categorizing stocks?
Lynch was big on this, don't treat all stocks the same. He'd slot this crypto-related stocks into his categories. Coinbase, Circle, maybe Robinhood. He'd likely see these as fast growers. These are his favorites, looking for companies growing earnings 20-25% a year, potential 10-baggers. But he'd watch like a hawk for any signs of that growth slowing down. MicroStrategy, that feels like an asset play. Its value is almost entirely based on the underlying asset, Bitcoin, not the operating business. Lynch was generally cautious with pure asset plays unless the asset was clearly undervalued. He might find the leverage here too risky. Visa, MasterCard, these are classic stalwarts, big stable companies. He'd watch closely how they're defending their economic moats against crypto disruption. Are their crypto initiatives actually adding to profits or just defensive costs? Palo Alto Networks, NVIDIA, these could be cyclicals, chip demand's ebbs and flows, or maybe even fast growers if their growth tied to AI and crypto is strong and consistent. They fit that selling the jeans in the gold rush idea.
Lynch might actually prefer investing in these essential suppliers rather than trying to pick the winning gold miner, CryptoCoin.
Categorizing them really clarifies the different risk-reward profiles. And his final, crucial test, find the story, then check the numbers.
Exactly. The story, crypto is the future of finance, is powerful, exciting. Lynch would get that, but then he'd immediately say, okay, great story, now show me the money. He'd demand you look at the financial statements. Is the company actually profitable? Or just burning cash on a dream? Is the stock price way too high compared to its sales growth? He used the PEG ratio to check that. How much debt are they carrying? Do they have enough cash to survive a downturn, a crypto winter?
Numbers, numbers, numbers.
They have to back up the story.
So the narrative is the hook, but the financials are the anchor. Let's imagine Peter Lynch is right here, giving direct advice to our listener who asked the initial questions. What would he say?
Based on everything he wrote and practiced, I think he'd say something like this. Excellent. You are already thinking like an investor by categorizing this industry into several groups. That's a crucial first step. Now, before you invest in Coinbase, try using the app yourself. See if their fee structure makes sense to you. And read Circle's annual report to understand precisely how they generate interest from those dollar reserves. That's the essence of investing in what you know. Next, you must verify if these companies are genuinely profitable and if they're carrying excessive debt. Never rely solely on the word future. No matter how captivating the story, it's meaningless if the financial numbers don't back it up. And remember this, Don't just blindly follow what Wall Street experts are praising. Trust your own research and understanding. Even if a stock price falls, if there's nothing fundamentally wrong with the company, that might be an opportunity to buy more with courage, not a time to sell in fear.
That's fantastic. It perfectly captures his practical, research-driven, and fundamentally grounded approach. That principle, invest in what you know, really does resonate beyond just stocks, into life wisdom too. So as a final thought for everyone listening, maybe reflect on how you use digital money day to day. How might that change in the next few years? And next time you tap that card or send money online, spare a thought for the hidden plumbing making it happen, because as we've heard today, that's where a quiet revolution might just be underway. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.